Welcome back. Earlier today, the Federal Reserve met and announced they're raising interest rates another quarter point to 5% from the prior 4.75. Taking a look to see how U.S. Treasuries closed for the day, the 6-month is at a 4.74 yield. Massive inverted bond curve still persists. The 1 year is at a 4.39. And the 10 years at a 345, so we have almost a 100 basis point or 1% inversion, where the 12-month is 1% or nearly 1% above the 10-year. And we see also a development where the 30-year now has a little bit of a higher interest rate than the 10-year, which is not an inversion, but really is not as relevant as the very widely watched 12-month to 10-year and 2-year to 10-year. But notice again how the majority of the yield that we see here are in the very short-term securities of 3, 6, and 12-month bonds. This represents a 1-month change. From a month ago, this is where the money flowed. The biggest move is in the downside, in the 2, 3-year bonds. Now again, when the yields go down, it means the prices of those bonds are actually going up. It's important to recognize that the 1 and 2-year bonds are moving down very, very rapidly. Again, the 1 and 2 are still, the 12-month and 2-year bonds are still very much above the 10-year, but we're seeing a compression. Notice we're at a 439, that's almost a 1%. We had 120, 125 basis point inversion at one point. The inversion is starting to disappear, and the way it's happening is actually very important. The way it's happening is that the short-term bonds are falling. It's not that the long-term bonds are going up. If we saw the 10-year going up by 50 basis points, that would be a different circumstance. We're going to talk a lot more about this in the coming weeks, but we're going to take another look back. If you look at what occurred in the year 2000 and 2007, we had an inverted bond market. And the way that bond market ended, that inverted bond market concluded, was when the short-term bonds, the 1-year bond, for example, the yield collapsed and crossed back below the 10. It looks like the same might be happening again. We're gonna take a look at the charts together and examine exactly how that happened last time. Notice though here, the 1 year, for example, that's the dotted purple line over here. At one point, the 1-year bond was at a 5.25. This goes back to March 8th, I should say, just a couple weeks ago. We're at a 1-year bond was at a 5.25. It has now collapsed all the way down to a 4.56, roughly speaking. The 2-year bond, which is the darker blue line, which is right over here. March 8th, we had a 5.05 yield, and now that's moving down, or has moved down, to a 3.96. Meanwhile, the 10-year bond, which is the red line here, is a 3.48. That on March 8th was a 3.98. So we've only gone down 10 basis points in the 10-year, but in the 1 year, for example, this dotted purple line again, we went from a 5.25 to a 4.56. So we've gone down 75 basis points on the 1 year and only 10 basis points on the 10-year. The same pattern did emerge in 2000 and 2007. That's how the bond market, the inverted bond market, ended. So that's very, very important. And we can see here the relationship between the 10 and the 1. The red line is a 1 year. The black line is a 10-year. And the red histogram bars below show us the level of inversion. So at the deepest point we had, for example, again, March 8th, we had 127 basis point inversion, where the red line was 127 basis points above the black. That ended, or not hasn't ended, but has dissipated. See how these histogram bars are going up. Eventually what will happen is the inversion will end. These histogram bars will go back positive the way they were in the past when they were blue over here. Maybe that's going to happen when the red crosses back below the black. That's our hypothesis, is how this bond market, the inverted bond market, ends. Does a red cross below the black, or does a black cross above the red? Generally speaking, when we see increasing yields on the 10-year, that's a sign of economic strength. That means traders have a lot of optimism about the future, but that's not happening now. It's pessimistic because the interest rates are going down, the yields are going down, not interest rates so much, but the yields on the bonds are going down, but the one is accelerating lower. The same pattern also exists with a 10 to the 2. Notice the compression. This was on March 8th. That was a really big, the lowest low we saw here. That 107 basis point inversion. The 2-year was 107 basis points, 1.07% higher than the 10-year. We now currently have a 0.48. So we have lost, or the inversion has dissipated by about 60 basis points. More than half of a percentage point has dissipated. If this red crosses below the black, that certainly could be a very significant sign to come. Check back with us often, because what we're going to do is we're going to take a very deep examination of how the bond markets behaved in the past and what was the behavior of the stock market after the fact as well. So we're going to watch this very closely. But again, Federal Reserve raises points by a quarter point, and the bond market inversion, while it's still there, it really is weakening. We look forward to seeing you back soon.